Ladies and gentlemen, we are witnessing what I would describe as an absolute massacre of all our hopes and dreams. Target down 24.5% today. 24.5% following yesterday's movement, down 3%. Walmart. Even Walmart is not immune. Down, in the past week, 16.69%, baby. But really, all of this happened in the last 2 days. Down 11% yesterday. Down an additional 6% today. It's a massacre. Even Kohl's, everyone is, they're feeling the hurt. Down 11% today. It's a rough time here, folks. We're going to be talking about Target earnings and seeing why, obviously, the stock is down 24, nearly 25% today. Yeah, we got a little hint when we looked at Walmart stocks earnings for sure. And we know what the issue is going to be, and this is going to be the actual net earnings of this company. There's a lot of macro-environmental concerns right now that are leading to worsening earnings conditions, right? From a retail perspective, we talk about rampant inflation. We talk about rampant wage inflation. And that's just how it is, okay? We look at these earnings. Let's take a peek. Non-GAAP EPS of $2.19 misses by 87 cents. It's a horrific miss. I will say there's definitely a bright side to both Walmart's as well as Target's earnings. We see revenue beats. These were expected to be flat years, and we see 4%. Now we can make the argument that this revenue increase of 4%, adjusted for inflation, actually shows it's negative, right? It's actually negative when you account for the increase in pricing, which, I understand. You can make the argument, but that's just kind of par for the course, okay? I mean, it's par for the course. The revenue is increasing. What do you want me to say there? Comp sales increased 3.3%. Traffic growth of 3.9%. That's not obviously anything to do with inflation. That's just good stuff. Store comp sales increased 3.4%. And digital comp grew 3.2%. So, for the second quarter, they're expecting operating income margin will be in a wide range. Centered around the first quarter's operating margin of 5.3%. So, again, worsening year over year. And for the full year, they're expecting low to mid-single-digit revenue growth. Not exciting. And operating income margin to be a range centered around 6%. Not good when you look at year over year. Here's what I have to preface this with, right? We'll look at the press release in just a second. This is the concern with these companies that have been making record-level profits over the last 2 years. We talk about ridiculous growth in revenues, ridiculous growth in profits over the last 2 years. Really benefiting very well off of, pandemic, right? These companies were benefiting very much so as people were spending a lot of money with ridiculous. Why can't I think of it? Stimulus checks, the government paying out ridiculous sums of money to people who don't have jobs, or just in general aid. Look, people had a lot of money, and now they don't have as much, okay? And now we're seeing inflation take over everything, right? Every company is facing it in a major aspect. You're seeing a lot of companies missing on an EPS standpoint, and a lot of that does come with also the unprecedented growth in wages over the last several years. This is not a good thing for companies. Maybe it's a good thing for individuals temporarily, but when their wage increases are not outpacing the inflation that is caused by this wage growth, then they're not gaining anything. They're losing. That's what people don't understand. And Target is one of those that is massively been increasing wages. Massively. They're continuously fighting to increase their minimum. And you see where that kind of hurts them, as they really, the only way they can stay at the same level of profitability they did before is by decreasing the number of people working there and or the number of full-time employees, so they decrease the number of hours and decrease the benefits they have to pay out. People don't understand the negative aspects that come with wage inflation. They don't. Increasing wages is not always a good thing for the average worker. In fact, it's mostly negative. It's really mostly negative. You're going to find it hard-pressed to get full-time work anywhere and or benefits. They're going to be cutting it somewhere. It's just how they have to do. They have to remain cash flow positive. It's the only way they can. But let's get into this press release. Did the stock deserve to be down 24%? Look, I don't think so. We look at the history of the stock. On the year, down 21 now. Still up over 189 over the past 5 years. And a lot of this gain you see came here from 2020. I mean, prior to this was up 150% from 2020 to 2022, really in a matching 2-year standpoint. So massive growth over the last 2 years. But, folks, that's not right to me. Okay, it's just not okay. Let's look at the press release, see what we got. Obviously, they're going to mention the 2-year stack, 22%, 22.9% growth last year. Now 3% this year. Obviously slowing, but that's not a shocker, right? It's still ridiculous numbers when you look compared to a 2019 level. Ridiculous numbers. 18% growth in store comp sales last year. Now, this is one thing that I really am hoping does not get perceived as negative by investors. And if it is, they're absolutely just imbeciles. Digital comp sales, obviously, as we saw, was only 3.2, following a 50.2% growth last year. If investors were expecting to continue to grow massive double-digit growth in e-commerce sales, they're truly incompetent. They're truly incompetent. This is not shocking because, look, the trend of e-commerce obviously grew massively last year in 2020. That didn't mean it was going to continue by that massive growth following that. People still want to go out and shop in stores, right? We said it from the start. They're still going to want to go shop in stores. Some people will stay loyal to the services, but a lot of people will just go back to their normal buying stuff in stores. Same-day services up 8% versus a 120% growth last year. Again, not shocking. More than 95% of Target's first quarter sales were fulfilled by its stores. Exactly. This is the point I'm trying to make. Look, e-commerce is a great additional business for them, but it is not the main core of the business. Okay? It's just not. Sales growth was led by food and beverage, beauty, and household essentials. Good for them. What else do we see? Well, that's great. The company reported GAAP EPS, so we're talking about actual, GAAP numbers here, down 48% year over year, $2.16 a share versus $4.17 of the first quarter of last year. Again, record profits, really brought on by record revenue growth last year. So that's not something we're necessarily shocked about. I mean, to see nearly half of what it was, it's painful. It is painful, but it's not a shocker in my perspective. 20th consecutive quarter of sales growth, that's good for them. I mean, we got to be positive there. Even through unprecedented sales growth, they're still growing. So that is a positive thing that we need to really point out in my perspective. I think it is. And obviously they mentioned here, despite near-term challenges, our team remains passionately dedicated to the guests and serving their needs, giving continued confidence in the long-term financial algorithm. And that obviously is showing mid-single-digit revenue growth over a short period of time or a long period of time, I suppose. It's a long-term financial plan. So, still, consecutive growth, I think I'm fine with. We didn't see anything great when we look at the gap or the guidance. We looked at that. Nothing super exciting there. I don't know what you're going to say. Obviously, income margin rate shrank in half nearly. Not good at all. We don't like that. As far as capital deployment, worth mentioning here, they paid $424 million in dividends versus $340 million of the last year. In this quarter, very nice. So, increase of 32.4% in the dividend per share, which is fantastic. In the repurchase program, they did enter the repurchase program here. That's set up for $2.75 billion, but they did not buy all that much. They only bought $10 million worth of shares in that quarter, which is very nice. Now, let me tell you, Q2 they're going to be selling, I should say buying a lot of this $2.7 billion worth of common stock, because they only bought $10 million in the first quarter, because I guess they kind of foresaw this happening, right? They could have foreseen this quarter. That's my guess is why they didn't buy all that much. But this quarter, Q2, they'll be buying a lot of shares, which will be great for shareholders. I mean, it'll be great, folks. We need it at this point. I'm going to look from a balance sheet standpoint. How do we feel about this? Well, first, I didn't really get to see a net income. Okay, net earnings here. This is where I like to see, down 51%. I don't like to see it, folks. Only $1 billion of net earnings this quarter. Not pleasant. Let me just tell you, not pleasant. It's not pleasant. I don't know what should we say. Cost of sales increased 10%. Not pleasant. That's what you got. From a balance sheet perspective, we're going to be looking at the far left column and the far right column year over year, because, again, we're going from massive profit to slowing profit. Let's see what we got. Total current assets right now sitting at really $18 billion. That compares to $20 billion the year prior, $2 billion less. But you see the cash and cash equivalents position has shrank pretty massively, and inventory's gone up quite a bit. Not a shocker. We saw it with Walmart too. This company, and really these retailers as a whole, are focusing on buying a lot of product now, trying to kind of beat this inflationary curve when they're going to be costing, it's going to be costing them more for inventory. So they're buying more inventory now than they typically would in the first quarter. So that definitely has an impact on that EPS line. And it's really not a permanent thing for them. It's a, more of a one-time purchase. I hate to say it, but it kind of is the case. So they're stocking up on inventory as a result of, not wanting to pay more in the future. I get that. From a total assets perspective, they're sitting right around the same, 50.8 compared to 50.4, so not much change there, all things considered. Nothing really shocking on that perspective. On a liability standpoint, currently sitting at 20.7 compared to $18.5 billion, so that did increase by right around $2 billion. Not exciting to see that, as accounts payable saw a bit of a rise, but it has shrunk over the last 3 months. Everything else pretty well stayed the same. And from a long-term liability standpoint, total liabilities here, or I guess the non-current liabilities, did see another increase as well. 16.9 compared to 19.3 this year. Rose around $2.5 billion in non-current as well. So that means, that's right, folks. Shareholder equity shrank quite a bit. Over last year, shrank around $5 billion, $10.7 billion compared to $15 billion of just a year ago. Shareholder equity seeing a little bit of a hurt, but look, folks, this reaction it's not warranted in my perspective. I think the stock is a great stock to buy. The yield is going to be going up massively, obviously, because of this big old 25% dip. And a PE ratio standpoint, it's trading cheap compared to the rest of the market still. I like targeting these levels. I think you should buy it. That's what I got for you.